Hello, very good morning to all. Welcome to today's Daily Dose of Market Insights by OANDA, and welcome to a brand new week ahead. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Very good morning. Today will be Monday, the 11th of March, 2024. So before we start our Daily Dose of Market Insights, let's take a look at the usual disclaimer. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice for any investment product, as well as any forecast, prediction, or projection in this presentation is not is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into today's short-term technical outlook on the cross asset classes, let's have a recap of what has taken shape last Friday on the performance of these cross asset classes. That means, i.e., I'm talking about the intermarket relationship between the stock market, the benchmark stock indices, the FX market, commodities in terms of West Texas oil and gold, and as well as what has also taken shape in terms of the release of key data on last Friday, stretching up all the way, as well as events stretching all the way throughout the last weekend, as well as today's early session. So let's start with the all important US non-farm payroll data first in terms of events release. Yeah? So let's look at the data over here. Okay, so what we have over here was last Friday, this all important non-farm payroll data. So non-farm payroll data was indicating to us that the US job market is still on a relatively solid footing. It's not indicating that we are now falling off the cliff, that the Fed will start to cut interest rate immediately or on a near-term horizon for this month where the FOMC is meeting. So what we could see over here is that non-farm payroll added much more than expected, but it's below 300k. So market is expecting 200k. It added in 275k. But what's interesting over here is that the previous month of January, if you recall over here, if I put my cursor, there was actually a downside reversion, revised downside from 353k initially compound to only 229k jobs added. So what we could see over here is that last month's short push up of 353k was a kind of an outlier due to a seasonality kind of thing. And also what's interesting over here is that the unemployment rate actually came down after this downside reversion. So the unemployment rate actually not came out, it actually went up. So it went up slightly by 2 basis point or 0.2 percentage point. So market is expecting no change at 3.7%, but it shoot up slightly to 3.9%. And average hourly earnings year-on-year growth inched down slightly to 4.3% year-on-year from 4.4% within expectation, and as well it was actually downward revised as well from last month, the previous month of January, from 4.5% to 4.4%. So what we could see over here is the US stock market growth is not growing as solidly as expected by market consensus, but in terms of the ongoing latest number in February, it also doesn't tell us that the US labor market is falling off the cliff, especially when I share with you the numbers earlier on where non-farm payrolls data managed to beat expectation, but it didn't went up to 300k. So all in all, right, all these latest we call it findings, data print from the US job market, which is considered as one of the key economic input that the Fed will take to decide their next step in their monetary policy. So far, no change in terms of market pricing of their monetary policy as indicated by the interest rate futures, which is being showcased in the CME Fed Watch 2. So based on the CME Fed Watch 2, the upcoming March meeting, which is i.e. the 19th to 20th of March, still indicating to us that, okay, give me a minute, where the hell is it? Okay, 1 second now, let me reduce the screen. I think it's too large over here. Okay, so no change market is actually almost pricing in no change for this coming 20th of March at 5.25% and 5.5% for the Fed funds rate, only a slight chance of a cut at 3%. So overall, even the main one also is not expecting any big change as well after the release of the latest non-farm payroll data that I explained to you is neither too hot nor too cold to actually advocate the Fed to cut rates on the near-term horizon in March or even in May. So only a small chance of 24% increase chance of a cut in May, but the rest of it is being centered in the month of June, where we have 57% pricing in a cut of 25 basis point and 16% pricing in a cut odds of 50 basis point. Okay, so if you look at the overall probability in terms of the entire 2024 by moving in down the diagonally, which I shared to you earlier on how to read this table. Let me expand to you. So this is a probability table indicate to us that based on the current interest rate Fed fund futures pricing, how much interest rate is being priced in 2024 in terms of interest rate cut are being priced. So for sure, this one over here, there is no, because now it's at 5.2%, no cut for no chance of a cut in May and March. So the chance of a cut will come in June. So there'll be one, they move on diagonally, there's this green light green box, 2, 3, 4. So based on the CME Fed Watch pricing tool, by moving down diagonally across the dates further out, potentially there could be 4 interest rate cut before 2024 ends based on the current pricing of the CME Fed Watch tool. So that is also in line with the dot plot. What is the dot plot? So dot plot is actually the Federal Reserve official forecast of Fed funds rates trajectory in 2024. So that was actually released last year December. So this dot plot is only released every 3 meetings, not every month meeting there will be a release of this dot plot. So the next dot plot release is very important, which come on the 20th of March. All right, so very likely it will be in the same scenario as what happened in last December, where most likely market will, the Federal Reserve official will still implied three interest rate cut before 24 ends, unless this week there will be a release of this CPI data. So unless this week CPI data shoot up tremendously to the upside, that totally change the thinking process of the Federal Reserve officials. All right. So with that in mind, right, but from a price action perspective, we start to see a weakness in the dollar, which I explained to you all last week. Why? Because of the US 10-year Treasury yield, and also the US 10-year Treasury getting softer below 4.33% also indicate to us lower cost of funding for gold, for holding gold, and that could actually also support this ongoing short to medium term uptrend in the gold price, which is spot gold XAU/USD, where last week we start to see the entire week of last week, the entire last week managed to see gold rallying tremendously and reaching a fresh all-time high. So that actually explains why gold prices is actually inching higher, because of the weakness in the US dollar, which is actually triggered by the weakness in the US 10-year Treasury yield. So let's ask very quickly, right? Talk about the US 10-year Treasury yield first, okay, in terms of the cross asset performance. So what we could see over here is on my screen, the US 10-year Treasury yield going to inch lower after the break of this 4.14%, which I highlighted to you. Softness can be seen at the lower limit of the major resistance zone at 4.33%. So what we could see over here is actually inching downwards. So this could be potentially the start of a new medium-term down leg, very similar to the down leg that we see earlier on in the last October to December. So in terms of the next resistance level to watch, right, for sure will be this level over here. Okay, this 3.87%. So this is the daily chart. So if you look at the weekly time frame, it gives us a much more clearer bearish configuration. All right, over here by shaping a lower high. Okay, a lower high. All right. So if we were to do a trajectory in terms of taking a ongoing potential descending channel linking from the high of the previous downtrend, a previous medium-term downtrend, and taking into consideration, okay, this previous push up here from the low of December low all the way up to the 4.33 resistance level, this lower high being formed, it could be evolving within this channel, descending channel that I draw on the weekly chart much clearer. So with the lower limit of the channel coming in at 3.3%, but that is for a longer term perspective. But we know that going forward, it seems to us that there is more odds of further weakness in the US 10-year Treasury yield rather than the US 10-year Treasury yield shaping a new major bullish trend. And that could actually translate to a weakness in the dollar index, which I explained to you. So looking at taking dollar index as a gauge of the dollar behavior. So over here, the dollar index going to plunge lower. So in today's Asia session, is now testing the near-term support level of 102.70, 102.75 level. So the next support level after this level breaks, okay, potentially will be this minor swing low for sure of January, early January this year, which is 100.80. Okay, 100.80. So what it means, it could means also translate to this down move after refusing to break the 61.8 Fibo retracement of the previous medium-term decline from 3rd of October to 28th of December, stalling at 104.85. So this particular weakness that we that we've seen so far on the dollar index could potentially translate into a medium-term downtrend. That means talking about a multi-week downtrend in terms of the US dollar index. That means, i.e., in general, medium-term downtrend for the dollar as well. Okay, so if you look at the weekly chart on this dollar index, it's also flashing this previously this bearish weekly shooting star, followed by last week this very strong bearish Marubozu weekly candlestick. Okay, so overall indicating to us that potentially the bounce from the start of early this year all the way up to the high of 12th of February, not long too ago, this bounce itself is more like a dead cat bounce rather than the start of a medium term to major term bullish uptrend phase for the US dollar index or dollar strength. Okay, so with weakness in US Treasury yield based on last week's price action, translate to weakness in US dollar index based on its latest weekly price action, potentially we will start to see a more pronounced dollar weakness going forward. But notwithstanding, on the intraday basis, we could still see bounces here and there. That means there could be some dollar pair that has already fallen a fair bit. There could be a what I call an intraday dollar strength rebound, depending on the individual dynamic of the dollar pair that we are actually tracking. But on a very broad, big picture basis, like I share with you all on the weekly chart of the dollar index and the weekly chart of the US 10-year Treasury yield, it seems to us there is a higher probability in terms of how the price action is involved. We may start to see much more potential multi-week US dollar index weakness going forward, which also could potentially translate to gold price being held firm at this current juncture. Now, the key thing over here is in the past, we tend to have US dollar yield softness, weakness in US dollar yield, US Treasury yield, not dollar yield, US weakness in weakness in US Treasury yield, and weakness in US dollar tends to actually translate to a positive price action behavior. That means a risk on behavior in global equities. That means looking at the US benchmark as a leader, because we all know that in the last few years, the US benchmark has been outperforming against the rest of the world. And also since the start of this year, it's being led by NVIDIA, which is an AI optimism team play story that's playing out. But however, on last Friday, the price action of the US 10-year Treasury yield and weakness and the US dollar weakness does not translate into this traditional intermarket correlation risk on behavior in the US benchmark stock indices. So it seems to us that right now in the shorter term, the US stock indices is moving itself, and it tried to decouple from that US weakness in the US 10-year Treasury yield, the usual intermarket relation. Why? Because the US stock market is currently being very top heavy, driven by AI driven play, especially Nvidia. So if you look at what happened on last Friday, the SPX actually went down negative 0.65%. The Nasdaq 100 also sell off negative 1.5%, and the Dow Jones Industrial Average slightly better, but still negative 0.18%. The Russell 2000 negative 0.10%. But what throughout the end, right? If you look at from a technical analysis perspective, I like to share with you. I like to see the price action that happened at the end of the week, because it's much very important. And how does the price action involve? So if you look at the price action across the board of this major US indices, starting from the SPX first. So if you look at the SPX over here, what we could see over here is that the price action of the SPX is actually now form a weekly spinning top. Okay, a weekly spinning top right below a key Fibo extension cluster resistance level at 5,220, 5,200. So with this appearance of this weekly candlestick that is not so bullish, also in fact is bearish, I would say, because of its the nature of its spinning top. And for those who look at a spinning top itself, and we look into account of two candlestick price behavior, taking into account of last week positive price action, this is what I call an inside bar. Also in terms of Japanese candlestick, is a bearish harami. And if you look at the higher beta Dow Jones, not Dow Jones, the Nasdaq 100. So the Nasdaq 100 also form a inside bar as well, which is taken into these two candlestick is a weekly bearish harami candlestick formation. The Dow Jones Industrial Average, okay, after last week not so positive price action, is last week was a bearish hanging man. Then what we see is a bearish candlestick follow through, a gap down, kind of a gap down on the weekly basis for the Dow Jones Industrial Average, also not so positive in terms of price action. And what we have over here is a former congestion area now turns into a pullback resistance, breakdown tested one times, congested. Then last week it pushed up but failed to break above this 2132 graphical congestion area for the Russell 2000, and the Russell 2000 also formed a weekly spinning top candlestick pattern. And like I shared about earlier on, Nvidia right now has been pretty much one of the main driving force on the US benchmark stock indices, especially heavily concentrated on the Nasdaq 100 and the SPX due to its highly component weight inside these two indices. So if you look at Nvidia itself, for sure, Nvidia price action also has on a weekly basis is not positive. So on a weekly basis, it came very close to a key Fibo extension cluster level at 1014.25, 1012,610. And what's interesting over here, it formed a bearish engulfing candlestick. Okay, if you look at this two candlestick price action, a bearish engulfing candlestick at the end of last Friday. And very interestingly, if you look at the RSI, the daily RSI has starts to form a bearish divergence as well. Okay, a slight bearish divergence showing similar high rather than higher high. All right, so all in all, what it could means that Nvidia right now, potentially after the formation of this a bearish element, two bearish elements that being seen right below a key resistance level, both from a price action perspective and from a momentum indicator perspective, like share that RSI. So all in all, potentially you could start to see the start of a potential multi-week corrective decline within its major uptrend phase that is still intact. So support level to watch 750, 627, 750 followed by 62720. So if Nvidia were to start to exhibit further weakness from here, it could actually drag down the major US stock indices, because it is it has a very significant influence on the price action on the major stock US indices, given this it's the leader of the ongoing AI optimism play. And we know that US major stock indices is the leader of the global indices. If US indices start to show weakness, potentially it could actually spread on to a negative feedback loop throughout the rest of the global indices as well. That means, i.e., it could impact the Nikkei 225, it could impact the German DAX as well, or it could also impact the Hang Seng index or the China index, given there's a slight correlation as well. All right. So with that, this is something to bear in mind. Okay. So that's pretty much sum up of what happened last week. Last week, in terms of price action, last Friday in terms of price action, and how does it translate to the broader base across asset classes. So let me touch on other key economic indicator, other key economic data that has been released over the weekend, and some news that took shape over the weekend. So one of the news that took shape over the weekend is US geopolitical tension with China is still at play. So over the weekend over here, in fact, Biden administration, the White House is currently waiting sanction on several China tech company, okay, including a memory chip maker called Chansing Memory. So what we could see over here is the US tech rivalry is still pretty much intact. All right, even though some of the leadership between these two, we call it China and US trying to mend relationship, but action speaks louder than words. So it seems to me us that the actions, the US administration right now is still ongoing out there to hammer out China, we call it a technology firm, by placing in much more sanction on them. And the reason over here is that because they do not want Chinese firms to actually overtake US supremacy in terms of the higher tech space in as this ongoing so-called a high-tech war between these two superpowers continue to persist. And much more interesting over here is that we got to see what's Trump's take on that, because bear in mind, Trump right now is the forerunner in terms of the more or less he is going to be the Republican candidate to represent the Republican party in this upcoming November all-important US presidential election. So the only way Trump may get, I mean, void out of this president's ticket to actually represent the US the Republican Party is he is actually being charged as a criminal in his ongoing lawsuits with several US district courts. Okay, something to watch out for. Now, going forward over here is that what's next today, early morning Asia session is BOJ. So right now, there could be persistence yen strength coming into the play, especially like I share with you, the dollar index is also getting weaker as well. There's a report by a local press, this reported by Bloomberg, saying that GG is a local Jing is a local press, saying that BOJ may consider considering stating amount of bond it plans to buy. And what it means over here is that there could be a chance that BOJ could consider scrapping its yield curve control program. Okay, but which is reported by this Jingjing Press, a local Chinese, a local Japanese press. That means what it seems to us based on current we call it analytical guidance by the press, by BOJ officials, it seems to us that BOJ right now is getting more and more firmer in removing their ultra dovish monetary policy, and there could be some much more firm guidance that is being given out in next week, 19th of March, BOJ, so-called BOJ monetary policy outcome, something to actually to keep an eye to to watch out for. And also on Saturday, what we see over here is Saturday we have the release of the China inflation data. So China inflation data actually came in way better than expected. So inflation rate year on year shoot up to 0.7% from the previous month of negative 0.8%, way above consensus of negative 0.3%. So if you look at the trend of the inflation rate, okay, in China, it seems to be now getting up from the deflationary risk spiral. Okay, so this particular jump in the February rate, so that could be due to CNY spending as well. It could be an outlier. So, but so potentially we need to see more subsequent months of a persistence move above the 0% mark. So, with that, this could be a potential outlier due to CNY spending, consumer spending. So, but nevertheless, it actually tell us that is the best reading so far in the last 11 months. All right, in the last 11 months. So in the previous 4 consecutive months, the inflation rate has been in a so-called lackluster, all right, a deflationary environment. But however, despite the fact that this could be, like I say, this could be an outlier. So one thing to say that why this is an outlier. So if you were to actually see the, where the hell is it? Okay, yeah. So if you actually focus on the oops, give me a minute. Yeah, over here. So if we could focus down on the if so-called the PPI. So this is the factory gate prices. So if you look at the factory gate prices, that means this is where businesses charge among businesses being charged on their raw inputs or raw materials to come out their finalized goods. It's still in a deflationary environment. So it actually worsened off than expected. So consensus is negative 2.5%. So it came worse, slightly worse at 2.7% year on year. So if you look at the PPI, so PPI itself is still in a deflationary environment now. So you look at the 5-year trend, okay, it's still hovering below the zero level mark. No signs of a recovery yet. So like I say, that potential spike up in that 0.7% year on year rate for the month of February in the consumer inflation data for China, the chart that I shared with you earlier on, could be just outlier due to that seasonality CNY spending. All right. So with that, let us take a look at the short-term technical outlook, all right, on the various cost asset classes. So let us start with the broad-based indices first. So yes, what we see this spike up in that's positive, better than expected CPI data in China. The Hong Kong 33 index managed to actually rebound. Okay, it managed to stage a rebound on today's price action. The only outlier against the rest of the other Asia indices, which is still down for the moment in time. So why do I say still down? If you look at the rest of the other Asia indices on my screen, Taiwan is down, the STX is down, Australia index is down as well. All right, only the current outlier is the China and the Hang Seng index that is kind of shaping this positive intraday performance due to the fact of that stronger than expected CPI data. But that could be an outlier. But from a technical analysis perspective, it's still holding below the 16,670 short-term pivotal resistance that we have last week. So as long as this resistance holds, we will still maintain that bearish bias. But first support level to watch for sure will be around that 50-day moving average and the lower boundary of this medium-term ascending channel. Okay, that price action managed to bounce off it. All right, from here, then that level will be at 16,260. All right, 16,260. So as long as 16,260 support level. Okay, so this is the first support level to watch. But however, if you start to see an hourly close above 16,670, then it will invalidate this short-term bearish bias to see the continuation of this very uh, ongoing counter trend rebound scenario towards the next resistance level at 16,860, followed by 17,010 slash 17,130. All right, so let me expand my screen so that you guys could see. Okay, let me expand my screen. Good. Okay, so now Nikkei 225, Japan 225. So Japan 225 bearish after the bearish breakdown of the 38,850 short-term pivotal support that we have. So price action is not encouraging since last Friday. Didn't actually retest that resistance level that we initially highlighted, 40,490 slash 40,690. Instead, it broke down, broke the 20-day moving average, and also break down below this near-term ascending channel support that I drew from the low of 4th of Jan. All right. So what we could see over here is actually the start of a potential minor corrective decline phase within its medium-term uptrend that is still intact, which is the price action is still holding above the 50-day moving average. All right. So what we could see over here is that the RSI is now coming very close to oversold level. So potentially there could be some kind of bounce taking shape. So this bounce potentially could start right at around the 20-day moving average over here at the 39,200 level, but I don't want to use 39,200 level so tight. So I'll be using 39,640 over here. That was last Friday's intraday high, US session last Friday high, and as well as the entire Fibo retracement of close to 76.4% Fibo retracement. All right. So in any potential chance that it may bounce, as long as the bounce didn't surpass 39,640, we will flip to a short-term bearish bias on the Japan 225. Next support level to watch will be at 38,100 slash 37,840. Only an hourly close above 39,640 will invalidate this short-term bearish bias to actually potentially revive the bullish tone for the next intermediate resistance zone to come in at 40,490 slash 40,690. Okay, so with the weakness on the Nikkei 225 as well the weakness on the US stock indices that I shared with you earlier on, I'll be less confident to maintain the bullish bias on the German 30. So German 30, you still recall, we were bullish. We do have a short-term bullish bias as long as the support level at 17,650 holds. So given the fact of the weakness in terms of the price action of the major US stock indices, I will be not so confident to maintain that bullish bias on the German 30 index. So we'll be flipping to a short-term neutrality stance on the German 30 index for today, 17,900 for sure. So that was actually the high of the Asia session, 17 on last Friday, 17,900 and 17,650. So neutral between these two range for today for the German 30. Then now moving on to the Nasdaq 100. So Nasdaq 100 last Friday we were bullish. So bullish we were looking at the first resistance level at 18,435 slash 18,470, which indeed the price action starts to actually shape that push up during the start of the US session. He pushed up, so it printed a high of 18,417, so almost hitting the resistance of 18,435 slash 18,470. Then thereafter it did that bearish reversal throughout the US session. So with that, right, we'll be flipping to a bearish bias for today, given that that bearish reversal right below that 18,435 slash 18,470 resistance. So it seems to me this is something like a double top. Okay, a double top. All right. Okay, so using that double top resistance level 18,335 as my short-term pivotal resistance for today. So potentially any bounce that may take shape as long as it didn't surpass, because I don't want to place it so tight at 18,095. Okay, so it may just get whipsaw around this zone, but it shouldn't be breaking above 18,035 if we were to actually see a further potential weakness going into play on the Nasdaq 100. So flipping to a bearish bias, as long as 18,335 short-term pivotal resistance holds, the next support level to watch will be at 17,810 level. So that will be the neckline of this potential minor double top. This will be the next support, a break below 17,810. So that also correspond to the ascending channel support that I drew from the low of 5th of January. A break below 17,810 potentially could expose the next support area at 17,650. All right, in the near term, only an hourly close back above 18,035 will invalidate the short-term bearish bias on the Nasdaq 100 to see the continuation of that bullish tone potentially, with the next resistance coming in at 18,435 slash 18,470. Above it exposes 18,565, 18,626 for the Nasdaq 100. Now, Dow Jones Industrial Average, the US Wall Street 30, we were neutral on last Friday. So indeed, it continued to congest in sideways, trading below the former ascending channel support. Minor ascending channel support now turns into a pullback resistance, and also can't really break above the 20-day moving average as well. So what we could see over here is that last Friday it kind of printed a slight higher high, but retested at the pullback resistance level of this former ascending channel support before its bearish reversal that weakness take shape, and upon that the hourly RSI also shape a bearish divergence. So all net all in all, right, as long as 39,000, because I don't want to put it so tight at this 38,850 level just in case of any whipsaw. So any potential bounce or whipsaw, as long as it didn't surpass 39,100 short-term pivotal resistance level, we'll be flipping to a short-term bearish bias on the US Wall Street 30. Next support level to watch will be at 38,360, which confluence with the 50-day moving average, and as well as the swing low of 22nd of February. Only an hourly close above 39,100 will invalidate the short-term bearish bias to see a potential squeeze up for the next near-term resistance to come in at 39,400. Now, that pretty much sum up for the indices. All right, so almost all across the board, it seems that we are more bearish than bullish right now. All right, now FX market. Let us start with the euro dollar. Okay, so for the euro dollar, last Friday we, okay, 1 second, press, okay, last Friday we were looking for a kind of a push up towards this 1097 before it trades sideways. So what we could see over here is that after it indeed hit the resistance at 1097, so initially we are looking for a kind of a pullback to take shape, but the price action, yes, it pulled back, but it didn't actually shape that very desired deeper corrective pullback, and the RSI continued to hold above the 50 level mark. All right, so with that, perhaps that pullback only may stall right at the next near-term support level at 1090 level. So I'll be using 1.0890 in any chance of this potential pullback. So as long as the pullback didn't surpass 1.0890, okay, why 1.0890 is important? Because for sure this is a very clear previous range resistance, tested 1 time, 2 time, 3 time, 4 time before it break, and thereafter it did a pullback and shaped that V-shaped recovery. So yes, there could be a chance of a pullback, but as long as this pullback didn't surpass below 1.0890, we will maintain that short-term bullish bias on the euro dollar. So with the next resistance level to watch will be at 110 followed by 110.40 next. Only an hourly close below 10890, then it will actually negate this short-term bullish tone to see a deeper corrective pullback to retest the 200-day and the 20-day moving average, now also conferencing at the next support level at 1.0845, which is also the lower limit of this minor standing channel that I drew from the low of 14th of February. Now sterling dollar, so sterling dollar also pretty much moving in track with the euro dollar. All right, moving higher, hit that resistance level. Also that pullback didn't actually this transferred to a very deep corrective pullback thereafter. So with that, right, I'll be using one. If there's a chance of potential pullback, this pullback should potentially stop at 12785. So what's 12785? Also very clearly, this former range resistance here now turns into a pullback support. All right, so if you do the Fibo retracement, taking from this last minor push up from the low of 1st of March to last Friday intraday high, that's correspond to 38.2% Fibo retracement. So as long as any potential pullback managed to help at the 1.2785 short-term pivotal support on the sterling dollar, we will still maintain that bullish outlook, short-term bullish outlook on the sterling dollar. Next resistance to watch after 2880 will be at 1.2940. Only an hourly close below 1.2785 will negate this short-term bullish tone to potentially see a deeper corrective minor pullback towards the next support area at 12730/127 figure level. All right, now that wraps up for the European currency. So let us go to the Asia currency on dollar yen. So you look at dollar yen right now, price action continue to plummet, okay, and is now test the 14620 200-day moving average as well, okay, and the former graphical area, okay, congestion area tested, bounce, then also a pullback support confluencing at the 200-day moving average, all pointing to 14620. Okay, so with that, right, if you were to look at the price action on last Friday, it's rather steep. Okay, it's steep. It broke through the 14770 level, where initially we are expecting a bit of bounce, but the bounce didn't actually take shape, just a very shallow bounce before plunging all the way lower. So upon plunging all the way lower, coming to test that 14620 level, which is the 200-day moving average as well, the price action on the hourly RSI continue to shape that bullish divergence. Okay, since it's now coming to come close to a key near-term support level at 14620, it actually increases the chance of this minor corrective dead cat bounce, not the start of a new potential impulsive up move. All right, so and if you do the Fibo retracement, okay, from this start of this minor decline all the way up to last Friday. Okay, the next resistance level to watch will be at 14770 for sure. Last Friday breakdown area /14815, which is also correspond to the 50-day moving average. The minor swing high area of 7th of Jan and 8th of Jan, 7th of March and 8th of March, and also correspond to the 38% Fibo retracement. of this ongoing minor decline that I drew. So as long as 14620 holds, given is a key support level, and as well as key near-term support level, I would say, as well as the bullish divergence, pardon me, that's being flashed out on the hourly RSI. So with that, we'll be having this short-term bullish bias for this potential minor counter trend rebound to play out. Resistance level to watch 14770, followed by 1815 before another bearish pressure reinserts into the dollar yen. So meanwhile, it's something like an overextended decline that is taking shape. However, if we start to see an hourly close below 14620, then this short-term minor counter trend rebound scenario will be invalidated to see the continuation of this impulsive down move within this medium downtrend phase that is unfolding. Next support level to watch will be 1550. So what's 1550? This congestion area over here, followed by 14450, the minor swing low area of 13th of Jan. All right, so that's for the dollar yen. Aussie dollar. So Aussie dollar going to be the outlier and it remains weak. So this Aussie dollar, right, managed to hit the short-term pivotal resistance that we have. So still recall on last Friday, we're actually looking at a bearish, a potential bearish reversal upon hitting the 6650. So indeed, the bearish reversal takes shape at 6650. And right now, the RSI continue to remain weak below the 50 level and hasn't even hit the oversold region yet. So all in all, right, what we could see right now could be the involvement of a minor corrective decline scenario that is still unfolding this Aussie dollar within a very complex, we call it a medium term and minor trend configuration. So what we could see over here is as long as 6650 short-term pivotal resistance holds, we'll still maintain that short-term bearish bias for this potential minor corrective pullback to play out. Next support level to watch will be at 6580, followed by 6560, which confluence with the former minor swing high area of 20th of Feb and 22nd of Feb, and also confluence with the 50-day and the 200-day moving average, all acting as this similar support zone over here. Only hourly close above 6650 will invalidate this minor corrective pullback scenario for the Aussie dollar to see the continuation of this short-term impulsive up move. To expose the next near-term resistance at 6710. So what 6710 is the congestion area of 8th of Jan and 16th of Jan, and so confluence with the former medium-term downtrend of 28th of December to 14th of February, that 61.8 Fibo retracement level. All right, so with that pretty much sum up for the FX market, a rather mixed one. The one that is still kind of showing dollar strength in the short term on the intraday basis will be the Aussie dollar and the dollar yen due to its overextended movement that was seen on last Friday. Now, spot gold. So spot gold did not shape that pullback that desired at 2165. It managed to break out over here. So the RSI also managed to hover above the 50 level mark. So it seems to us that it's now going to involve in a very persistent uptrend without any significant minor corrective pullback. So with that, we'll be flipping to a bullish bias. So the first resistance to watch will be at 2175, followed by this last Friday minor swing low area. So I don't want to use 2175 as a short-term pivotal support level. So I use last Friday swing low area instead at 2153. So as long as any potential minor pullback managed to hold above 2153 level, we will still maintain that short-term bullish outlook. We will actually flip to a short-term bullish outlook for spot gold XAU/USD. Resistance level to watch, first resistance 2200, followed by 2210, above it 2220, followed by 2230 Fibo extension level, as well as the top of this minor ascending channel that I drew from the low of 1st of March. Okay, and also correspond to the major, this is the dark light green, highlighted much more in higher degree. I mean, it has a thicker line. So what's this line? This light green line over here, if we go to the daily chart, is in fact the major ascending channel upper limit that I draw from the low of 3rd of November. So that is an important resistance level, which is the 2220, 2230 level. All right. Now, WTI crude. Okay, so WTI crude, very choppy price action again, broke below 78.14 level. So with that, right, 78.14 was my short-term pivotal support on last Friday, looking for the potential bullish buyers to resume towards 81.65, but price action refused to actually go up and starts to reintegrate back into that range configuration that is in place since November last year. Okay, this very choppy range configuration. So with that, right, we'll be flipping to a back to a bullish bias within this range configuration with this level here, 80.55 as my short-term pivotal resistance that has kept the bulls in check since 4th of March. So as long as 80.55 short-term pivotal resistance is not surpassed to the upside, we will flip to a short-term bearish bias within this complex range configuration. Next near-term support level to watch will be at 76.20, followed by 75.75, with so confluence with the 50-day moving average. Only an hourly close back above 80.55 will negate this or invalidate this short-term bearish bias to expose the next near-term resistance level at 81.65, followed by 82.80/83.20 for West Texas oil. Okay, so with that pretty much sum up for the short-term technical outlook for today. So before we go, let's take a look at the economic calendar to see what other key economic data to watch out for today. Today over here is a pretty much quiet session for today session. So let me do a double check again, the calendar. Okay, let me have a full week of calendar for this week. Okay, good. So for later part of today, there will be pretty much quiet session, nothing to really take note of. So yeah, so only coming to early Asia session tomorrow, we do have Japan PPI data, year-on-year data period for February at 7:50 p.m. AM Singapore time. And we do have a business confidence data out from Australia at 8:30 AM Singapore time tomorrow, before the start of tomorrow's daily dose. So with that pretty much sum up for today's daily dose of market insights. So I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.